Hello and welcome back to the course. In this lecture, we're going to learn the basics of financial statements analysis. You will learn the overall structure, what you're going to analyze, and we'll also discuss some general definitions that you will need. Let's go.
Why can you be interested in a company's financial results? The two basic reasons are that you either want to buy the company's debt or equity or shares, or you already have its debt or shares and you want to understand whether the time has come to sell it. Your analysis will differ based on whether you are interested in shares or debt. We will have a special lecture about analyzing a company from a debt holder's perspective. Otherwise, throughout this part of the course, mostly we're going to be talking about the analysis of financial statements if you are interested in companies' shares. What do you analyze when you look at the financial statements of the company? There are four major areas that we're going to discuss throughout this section of the course. The first one is, of course, profitability. It's like the most important part of analyzing any business, because business is all about profits. If the business does not generate profits for an extended period of time, then it is going to be liquidated. The first area is profitability. We're going to talk about it in more detail in this lecture, but basically the whole profitability analysis is about learning the structure of costs of a company, what each component of the cost represents as a percentage of revenue. The next area is important for some companies, mostly brick-and-mortar companies that have physical goods. It is working capital management and asset utilization. We'll have a special separate lecture on working capital management, so do not pay attention to it at the moment. The third area is debt management. In this area, we analyze whether the company has too much debt and whether it can have any problems with repaying its debt either in the short term, which is called liquidity, or in the longer term, which is called solvency. And the fourth area of analysis is analyzing the share price of the company. That's where we use so-called multiples. We will talk about them in more detail. At the moment, the brief description is that a multiple is the relation of a company's share price or its market value to some financial indicator of a company, such as its net income or sales or EBITDA, and we're going to discuss it in more detail. Before diving deeper into the topic of financial statements analysis, in this lecture I would like you to learn several definitions, notions, that I will use extensively throughout the rest of this section of the course. The first one is EBITDA. We talked about EBITDA briefly in one of the earlier lectures in fixed assets. Again, the definition is that EBITDA is earnings before interest, tax, depreciation, and amortization. What does this all mean? And why is EBITDA important? Basically, EBITDA shows the raw results of the business. If you take sales and deduct all straightforward monetary expenses from your sales. For example, you have to buy something from your suppliers. You have to pay your employees. You have to spend some money on marketing. You have to spend some money on your research and development. These are all real costs of any business. If you want to continue your business, you will have to spend money on those expenses. And EBITDA shows you the financial result of the company after you deduct all those costs from the sales results of a business. It does not take into account how you finance this business. It doesn't take into account interest expenses. It doesn't take into account taxes. If a company's EBITDA is positive, then this business can keep working because it generates money. If your EBITDA is negative, then there is some problem with your core components of the business. It's an important measure because if your business generates EBITDA, if it's EBITDA positive, But let's say it has too much debt and your interest expense is too great for the business to be able to support such interest payments, then it can be fixed. You can restructure your debts or they can be written off by your debt holders. But in any case, the business will continue functioning. But if you are EBITDA negative, then you need to fix the business. Otherwise, it doesn't matter if you are able to restructure your debts or if you have any debts at all. The next notion that you need to remember and understand is two abbreviations, the EV and MV. MV stands for market value, also called market cap or market capitalization. It is basically how much the shares of a company are worth in the open market. For example, if you have 1 million shares outstanding and the share price is $10, then the market value of a company is $10 million. Enterprise value shows you the total value of the business in itself, independent of how it is financed. Any business belongs to two types of stakeholders. These are the shareholders and the debt holders. If you imagine a business as a pie, then this pie is sliced into two pieces. The first piece is shareholders. They own part of the company's cash flows and assets. And the other part is debt holders. They actually also own a part of the company's cash flows and assets. So the enterprise value takes this into account and shows the value of the business in itself. In order to calculate the enterprise value, you have to start with market value. Market value shows how much money shareholders have. And then you need to add your debt to the company's value. And then if a company has any excessive cash, then you should deduct the excessive cash. Let me give you an example. Suppose we have this company with 1 million shares outstanding and the share price is $10 a share, so the market value of the company is $10 million. But let's say at the same time the company has 3 million in debt. So the total value of the company in this case is $13 million. The shareholders own 10 million and the debt holders own 3 million. So in total, the world values this company at $13 million. So simple. But there is one caveat. Suppose this company has, let's say, $3 million in cash. It just has a ton of cash. It took the loan, it still has all the cash, doesn't really need this cash. So what do you do with it? In this case, you can say that at any point in time, the company can easily repay its debt in full. So it is not proper to value this company at 13 million because it actually does not have any debt, because it can repay this debt using this excessive cash in full. So in this case, what you do is you start with the market value at the value of debt, and then you have to deduct this excessive cash. So in our case, the market value of the company will be equal to its enterprise value, because even though it has 3 million of debt in the books, it also has so much excessive cash that effectively its net debt is zero. So what does excessive cash mean? You need some cash in order for the company to run its day-to-day operations. There is a rule of thumb here. For most companies, about 2% of sales in the cash balance is more than enough to keep doing their business. So anything that's more than 2% can be considered excessive cash. Let us talk about margins analysis for a while. Let's have a company with some standard representation of its P&L. So the company has $100 in sales and its cost of goods sold, COGS, is $40. Then goes the gross profit. The gross profit is 60. You can represent it as a percentage of sales. In our case, $60 is 60% of our sales. And we can say that our gross profit margin is 60%. Then come our operational expenses. All those expenses for marketing, for R&D, our personnel expenses, administrative expenses. In our case, it's $35. And together, if you deduct them from our gross profit, you will be left with EBITDA of $25. That means that our EBITDA margin is 25% of sales. Then if we deduct our depreciation, some other non-monetary expenses, then we come at an operating profit. In our case, the operating profit is 20, which represents an operating profit margin of 20%. Then you deduct the interest expense, taxes, and you are left with the net profit, and in our case it's going to be $12, or we can say that our net profit margin is 12%. When you analyze the company's profitability, you cannot analyze a company in an empty space. Suppose the gross margin is 60%. Is it good or bad? We don't know. It depends. If you analyze any financial statements, the most important thing that you need to do is get two things. First of all, you have to analyze the company's performance in dynamics. You need to take several years. For example, if you analyze the gross margin of the company, calculate it for 3 years in a row and analyze the dynamics. Is the gross margin growing or shrinking? What are the reasons for that? The other thing that you can and need to do is you need to find comparables, or just comps. Comparables are similar companies that work in the same industry, and then you analyze your target company's margins in comparison with its peers. Because again, you cannot analyze the company in an empty space. Again, EBITDA margin of 25%. Is it good or bad? If competitors make only 15% EBITDA margin, that's very good. But if their EBITDA margin is 35%, then the company performs poorly. Why is it important to find the right comparables? Because if you get some comparables wrong, then you can get a wrong impression about the target company. For example, if the companies are in slightly different businesses, then their financial results can differ, and there will be good reasons for that. When analyzing financial statements, you first need to understand the nature of the business, the essence of the business, and then you will be able to find the right comparables.
So now hopefully you understand the basics of the financial analysis, what areas you are going to analyze if you take a company's set of financial statements, and some definitions as well, such as EBITDA or market value or enterprise value. In the next lecture, we are going to talk about how you should analyze a company if you are acting as a debt holder or a potential debt holder for the company.